Thank you all for joining us. First webinar of the year. Hope you guys are as excited as I am to get through what is hopefully a better year than last year in crypto. So for today, we'll dissect the bear market that we experienced in 2022. Focus on what I'm calling the three arrows behind the bear market. So the Terra collapse, the credit crisis, particularly with centralized lenders in the space, the FTX fraud and its contagion, and finally a bit more of a outlook for 2023, hopefully less grim than the last one. Quick update about Into the Block. We launched I think it was 14 new metrics for our analytics product, many of which are ratios related to the market cap or supply. So we now track circulating supply, which we frankly had been tracking it for a while, but we productized it. More ratios like the amount of open interest in perpetual swaps relative to market cap. This one's quite interesting as a proxy to leverage in the system, which has been declining sharply since the FTX crash, and a few more old school crypto and chain ratios like the NVT or MVRV. We also launched metrics like the transaction size distribution, the holding time of transacted coins, which tends to spike near tops or bottoms, and the balance by holdings in dollar terms. We previously had it just in crypto terms. So feel free to check these analytics out. Feel free to use the Q&A and the chat for questions. I didn't introduce myself because I do these webinars constantly, but I'm the head of research at Into the Block. Been in the crypto space for 6 years now, and hopefully you guys are ready to chime into the webinar. Aside from the Q&A, we'll also be taking a look at the chat, and we'll have a more in-depth Q&A session at the end. We've also been working on partnerships with our analytics distribution. We launched in our analytics within a wallet called Swipe. It's a mobile wallet, very easy access from the bank accounts to layer 2s, and we provided some analytics there. Okay, so actually I was going to say without further ado, but we have a lot in store for 2023 in crypto. So we're launching a risk radar product that we've worked on with a lot of DeFi protocols. You have a few metrics here to tease it. We'll be launching new networks for the analytics. So we're launching Optimism and Arbitrum, relaunching Cardano, which had some issues there. And we're improving the UI across the board with some general metrics and then a bit more customization for users. And finally, API access, hopefully towards Q2 or a bit later. Now, without further ado, let's dive into what happened in 2022. Okay, so as I was mentioning, three main drivers that exacerbated the bear market were internal to crypto. There were also, of course, external factors like macro that perhaps led to these collapsing faster or sooner than they would have if not. But ultimately, a lot of these were bound to happen since they were not resilient enough to last during the bear market and were mostly bull market phenomena. One perfect example is the dose of risk exploits. And this can be economic risk or technical risks. So within Terra, we will argue that it's an economic risk attack. We'll get into that a bit later. But also, of course, so many technical attacks that occurred in 2022 that ended up putting pressure on the industry. And that was also one of the arrows there. Then we have the lending credit crisis, where three arrows themselves sparked this a bit further as lenders got riskier and riskier practices in place. The FTX fraud, which was frankly an all-right upfront embezzlement of funds. We're seeing now that they had apparently $65 billion in credit from Alameda from FTX customers, and the contagion resulting from that. And macro, frankly, we've covered it significantly in some of our newsletters, so it won't be the topic for now. I believe probably many of you are tired of listening about macro, so we'll stick to crypto for today. And within the bear market, we see these recurring patterns emerge. So one is unsustainable practices that, as I mentioned, were mostly like a bull market phenomena. They're a double-edged sword that, it might drive adoption in the near term, but it can lead to infrastructure that's not resilient enough to last during the bear market. Terra is the perfect example of this. We also see across the board some of the highest egos in the space go to zero. So people like Do Kwon, Zhu, Daniel Sesta, SBF, of course, some of the most prominent people in crypto collapse, which is perhaps more of a psychological thing to study, and we won't get into that much, but it's very interesting pattern nonetheless, and a striking thing to consider if and when we have other bull markets, probably when. And we also see smaller players rise as a result of these very large, prominent institutions collapsing. We see smaller players readapting, restructuring, and trying to move past the aftermath. And we also, as a result of the fear and the high focus on some of these personalities, we see the collective consensus of people starting to doubt things that they saw as constants. Now there are variables in their head, and therefore it's creating a lot of uncertainty, fear, and it's taken a bit of time for the industry altogether to cope with this. So starting with risk exploits, Terra, which you may argue was bound to collapse since it had some unsustainable practices built in. It collapsed, leading about $50 billion in losses, by far the largest. Between the Terra token value, UST, as well as some of the ecosystem applications built on top of it. We then see a lot of bridges hacks. So that was by far the biggest honeypot for attackers last year. So over 2 billion between all bridges hacks, including Run-In, the BNB bridge, Wormhole, Nomad, and a few other protocols like Beanstalk. This was a more particular governance attack. Rect News, if you guys are interested, Rect News is a great source for all of this. Moving into Luna, it was a curse. It was a victim of its own success in a way, because what led Luna and UST to grow so fastly were these built-in Ponzi-nomics, where to get UST and to access that infamous 20% yield in Anchor, you would have to burn Luna. And effectively, that led to the supply of Luna to decrease more and more and more as demand for UST increased. But you see the reversal of that happen when UST starts depegging. It effectively prints more supply as there is less demand to hold UST. And this effectively led to the collapse of Luna. You could argue it worked as intended. It just wasn't a sustainable system to begin with. And here, since many deep in the space knew that this was a possibility, there are arguments to be made that an entity, perhaps FTX, was the one behind this. And I don't want to get too conspiracy theorist out here. So I'm just trying to keep the facts, and it seems quite likely that this was the case. Effectively, what happened in February FTX launched UST perpetual swaps that effectively allowed people to speculate on the price of UST. In April, the Luna Foundation Guard sells $1 billion in UST to Genesis, the lender, and it's allegedly to support the ecosystem. And UST, between these months, they were aware of the death spiral risk, and they were buying Bitcoin to help support the peg. So effectively selling some Bitcoin if it were below the peg to buy more UST and push it up. So, and they were also shifting the liquidity away from a curve pool to one with a more structured design. They were calling the 4 pool. So in May, they began this rebalancing process of liquidity. And it was at a point where they were neither settled in the new pool, but they already had seen significant outflows in the existing curve pool for USD, which was by far the largest source of liquidity for USD. Then we see around this time in May that Alameda opens a large 9-figure BTC short, so in the hundreds of millions, as tracked in disclosed in the Voyager bankruptcy docs, since Alameda and FTX were trying to acquire them. And there's an entity which right now is still undisclosed by Genesis that received those $1 billion in UST that had previously been held by Genesis, and those begin being sold in open market, effectively kickstarting the depegging scenario for UST, of which also led to the crash in BTC price, since it was sold off to try to support UST. And then effectively, as more and more supply enters the market of Luna, it enters this death spiral. So it's still not clear if it was FTX or Alameda, but there's a criminal investigation going into it and tracking on-chain this activity, as well as with the bankruptcy filings, can be quite interesting, to say the least. So I don't want to jump into conclusions right away, but it does seem like it was an orchestrated attack. And as I was mentioning, these things that people saw as constant, so like USC was pegged to $1 consistently or relatively consistently up until then. After that, it raises questions of what other things that are supposed to be pegged are not pegged. So USDT Tether actually crashed to like 96 cents, 95 perhaps, in a few markets, but it was still able to overcome any depeg fears, at least over the longer time frames. As stake ETH also, Lido's stake ETH was consistently 1-to-1 before the Terra scenario, but it also led a lot of people to reevaluate their exposure to stake ETH and the risks that it has. So therefore, it led to a crash in stake ETH, particularly as contagion started unfolding from Terra, and large funds like Three Arrows that had exposure to stake ETH, as well as Celsius, started unwinding these positions. And so here is when we see the dominoes start to fall in place and effectively exacerbate the bear market full throttle. So in the background, since 2021, CFI, so centralized finance lenders, were competing for yields for deposits from customers. So what they did as yields became more scarce is that they effectively started taking riskier bets in order to have those high rates to attract customer deposits. So this is a bit similar to what we saw in the great financial crisis with collateralized debt obligations, where they repackage riskier products into one and hid those risks away from the consumer they were not aware that they were taking these risks. And so they start pursuing things like depositing into Terra for yield, or offering yields to offering loans to more riskier borrowers like Three Arrows, or at high concentrations under collateralized loans. I see a couple of people raise their hands. We do have questions towards the end, so I'll leave those two there. And so, as all of these trades started unwinding, a lot of the lenders effectively lose depositors' capital, and they freeze withdrawals since they end up in positions where they have less funds than the customers deposited. So that's why BlockFi, Voyager, Celsius, and a few others freeze withdrawals, especially after they realized that Three Arrows had also committed fraud, and they wouldn't be able to repay their loan. Effectively, they lied about the amount of crypto that they held, and sort of told the same story to all the lenders without them cross-checking. And so here we also see some entities already starting to take a hit. So just right out of the gate, May and June, we see BlockFi, Voyager, Celsius, what used to be industry giants, they're effectively dead from that moment on. And we see Genesis and FTX pretend that they're okay after this, but they're largely hit afterwards, as we start finding out now with more information. We see a similar unwind of credit in DeFi. So centralized finance, of course, is not as transparent as DeFi credit. So we can see here the amount of loans outstanding in DeFi increased significantly as there were high yields opportunities related to the bull market and such, and collapsed very sharply after the Terra collapse. But nonetheless, they're down about 60–70%. CeFi credit, if you consider that Genesis had about 100 billion in loans outstanding and now it's down to 3, that's 97% down. Celsius went from tens of billions to 0. BlockFi went from tens of billions to 0. So by conservative estimates, CeFi credit is down 95%. Unfortunately, we can't track that, but the Celsius Cell token price is a somewhat good reflection of the boom and bust in the credit, CeFi credit, down 95%. And we see what were smaller players like Nexo or Ledin still pushing forward and try to persist after in this aftermath and restructuring to be more sustainable longer term. And then finally, we see the third arrow, I guess, within the bear market, which is the FTX facade that they were playing. As probably all of you know, they were consistently pushing for regulation in the space, and they appear to be the media darlings, SBF, and the crazy amazing growth that they were allegedly having ended up being boosted illegally. So already in May, even if it's unclear how, it's been revealed that they were down between 1 to 2 billion after the Terra collapse. I know I mentioned that they were potentially likely behind that, but there's an argument that since Alameda was backstopping liquidations in the FTX markets, that they could have ended up with bad debt from covering those liquidations that occurred quite rapidly. They also most likely did some bad trades that we haven't gotten enough details on. And what we do know is that they did a lot of VC investments, so a lot of illiquid investments that they couldn't access near term. And so we find out that FTX effectively gets a loan from Alameda, gets a loan from FTX, backed both with FTT tokens and customer deposits. Today morning, I was reading that apparently Alameda had access to as much as 65 billion in credit, according to a CoinDesk article, from customer deposits. So not only like all the assets that they had in store, but more if it had climbed. So in a way, it's better that it collapsed now rather than continued growing. And this was all right, like upfront embezzlement from like customer funds going to Alameda to fund riskier and riskier bets. So this was bound to collapse in a way. And we see in September, this is one of the few traces that we have from on-chain activity, illegal things going on in FTX on-chain. So Alameda was one of the largest investors in FTX, and they, you can see on-chain that they received $4 billion getting into supply, and they repay that, send that right away to FTX. 4 billion at that moment. Sam said that they were doing rebalancing some addresses and to not panic. But it seems like this could have been a loan that Alameda received for $4 billion from FTT. And perhaps even more strikingly, after all the FTX collapse starts unfolding, we see about even more in tokens, but less in dollars. I think it was like 20-30% of the supply that was supposed to be locked and go into the market over time. They were just abruptly shipped into the market. Most likely a lot of these tokens sold as the fraud gets uncovered, and then also FTX US gets hacked, or someone accesses those funds somehow with a backdoor that they shouldn't have had. And from all of this situation, as you know, most people in the industry were struck by this, especially given the whole imagery that SBF and FTX had around them of being like a fantastic overnight success. That we see Genesis that had some exposure to FTX, also paused withdrawals after all the hits that they had been taken. We see Gemini, who had their own earned product that used Genesis, also pause withdrawals and start a lawsuit against Genesis that's currently still unfolding. We see teams and funds, both VC funds and hedge funds, lose capital stock on the FTX platform. And there's an estimated about $10 billion in customer deposits from approximately 1 million users that were stuck there by the moment everything crashed. I believe from also the article this morning that they have apparently 5 billion of those. So that's all in all relatively high amount for what was estimated initially. And the process is still ongoing. We're still likely to see some of the second and tertiary effects from this come into place. But the good thing is market is stabilizing in a way. I forgot to mention there were a lot of outflows. So again, the constant to variable leads to doubts. So they saw FTX as a consistently great exchange. And now that is not the case, people start wondering if Binance is also insolvent, if they also did something like this, since they have a BNB token. And so we see billions in withdrawals from Binance. This also positively leads to a greater push towards proof of reserves. And I think we're likely to see more restructuring in the market based on that. And so the fear, in a way, is still stalking around, lingering in the market. But the market, the prices have stabilized. So there's still USDT fears that you hear every now and then. There's still the Gemini and DCG lawsuit. And what I'm seeing is this obsession over 100% drop, what's going to be the next collapse, next large thing to collapse. Just like in 2021, people were wondering what's going to be the next thing to do 100x gain. So it's an interesting parallel. It also leads me to believe that if we're not at the bottom, we're probably close to it. And this is not financial advice, but we're just seeing like too much of the extremes taking place. We're running a bit short on time, but 2023 outlook, I think we're likely to see many things develop for the industry altogether. For Bitcoin, it's clear that what many people saw in 2021, that it could be a potential inflation hedge, that's been disproven, at least for now. It will take some time for that narrative to rebuild if it ever does. We also see miner profitability drop significantly as energy cost rises and also price drops, so revenues drop. However, there's hash rate, so that total amount of mining power going into Bitcoin has continued to increase, also makes it more competitive and less profitable. I think we see the same pattern in 2018, and later miners start shutting down operations. So we're likely to see a bit of a capitulation in miners, or at least in their hash rate. For the moment, that's one potential thing, like negative cloud hanging over Bitcoin. At the same time, though, we're seeing this sort of self-fulfilling prophecy of Bitcoin as a digital gold. And the way that is carried forth is effectively just insistent behavior from long-term holders that have time and again supported during bear markets accumulating. So we see that in 2014. So it's a ongoing pattern. We'll see if it continues to persist. But where hodlers effectively sell during the bull markets after all-time highs, and then they accumulate in the bear markets. So we see it in 2018, we see it in 2022, sorry. And this has slowed down a bit, but it increased significantly right after the FTX exploit, collapse rather. So this to me is a sign that, you know, the long-term holders are sticking around. They're not playing. They continue to accumulate, and that's in a way sets the floor for prices and leads to longer term appreciation that can support the digital gold narrative. There's also the Bitcoin halving occurring next year, April 2024. In 2019, a year before the 2020 halving, we saw a very large rally, so a lot of people can potentially anticipate something like this. That being said, the amount of Bitcoin issued every block is almost negligible now. So we have this indicator in a block called the mining rewards volume share. So it's essentially what percentage of the mining rewards make of the total volume. That amount is very, very small. So it's sitting about 0.1% only right now, and it's climbed as the volume has dropped. But I think in a way it's so small that we really shouldn't count on this to bring, you know, the same halving rally that it used to. I think the psychological aspect behind it has a lot more to do. And now that the stock to flow has effectively been debunked, I think we're more likely to depend on demand side indicators than supply ones. Then for Ethereum, we see the Shanghai fork taking place, expect to happen either in March or in April this year. And this will allow the ETH being staked to exit to be unstaked. So there's been people depositing there since December 2020. Arguably, some of them will want to withdraw some of those funds. That being said, there's a common misconception that all of that will storm the market. That's not the case. In the Shanghai fork is programmed such that you can only withdraw. I think it's, I'm forgetting the amount per epoch, but it translates to 30 to 40,000 ETH being withdrawn per year. And there is almost 11 million in total being staked, perhaps a bit higher. This might be outdated. And so that would take over a year for all the ETH staked to be withdrawn. And at the same time, the percentage of ETH staked is much lower than other proof of stake chains. So the ability to unstake in a way might make people more comfortable and effectively lead to more deposits in staking. I think we're likely to continue to play this out. But it's one of the reasons why we're seeing liquid staking get so much price traction as people begin anticipating that actually more people will stake after Shanghai than before it, since it's a very slow outflow, and it could lead to a lot of confidence to go in. Other than that, in Ethereum, we're also seeing the transition to layer 2s. So Optimism and Arbitrum are already doing almost as many transactions as Ethereum. So that's caught up significantly. I think they 4x'd in transactions in 2022. That's likely to continue, and EIP 4844, what they call proto-dank sharding, will decrease costs of layer 2s rollups by 100x, so it will become a lot cheaper, so less than a penny to use these networks. And there's also CK rollups, CK EVMs coming into market in 2022. So I think we're likely to see increased amount of activity in layer 2s and in Ethereum altogether as those prices drop. Moreover, in other smart contract platforms, we see Solana taking a risky yet novel approach at launching their own phone that's supposed to be launching early 2023. I think they're shipping the first demo phones over this month, and that will be more native support for crypto applications. Right now it's mostly on desktop, so it should unleash a lot more applications, especially with Apple being insistent on doing things like charging 30% taxes for NFT transactions, which really are settled on chain, and it's very inconvenient and unreasonable in a way to do that. So I think that'll be something interesting to watch out for. Also, Cosmos interchain security, where Atom secures other app chains in its ecosystem, should drive a lot of activity. Avalanche subnets have also taken a similar approach, and that should also be something to watch out for in 2023. In DeFi, I think we're likely to continue to see stablecoins do trillions of transactions. They already did trillions in 2022 and 2023. I think we're likely to continue down that route, especially as inflation sets sail across the world, particularly developing markets, of course. Where Aave has been teasing a debit card that's still in the plans from an update they gave. Uniswap is rumored to be launching a wallet that could make the user experience a bit simpler for users of its application and perhaps others in DeFi. And we're also seeing experimentation of use cases that have been teased back in like 2020. They're finally coming into fruition. So Ondo Finance just announced that they're bringing bonds on chain, so T-bills that people can finally get yields on chain without having to go through the traditional cumbersome route. And also yesterday there was the launch of a real estate application called Parcels, where you can effectively go long or short real estate prices depending on the median square footage price, which I thought was quite interesting. And finally, we see NFTs as a Trojan horse for crypto. So we already saw 5 million users, most of which were new to crypto, buy Reddit avatars. They're not even mentioning the word NFT at all, given misconceptions around it. But we're seeing a lot of traction. So that's a positive sign. We're also expecting Polygon to launch their Odyssey program this year, where people can collect rewards in a gamified experience using NFTs. They call them Starbucks stamps of certain stores. That will also get more people using these applications, as well as, of course, Instagram, that has been teasing NFTs within their platform for a few months now. And finally, gaming has also been talked about for a long time. A16Z, the VC, has invested in a lot of these, and they claim that many of these are launching this year. So we're likely to see a lot of new games enter the market, fight for users, and also existing games perhaps integrate NFTs just as an additional revenue stream in line with their existing operations. So I think there's many dynamics that will collide in crypto in 2023. Altogether, I think it's positive that we got rid already of the excesses and unsustainable practices that built during 2021. Those have been wiped out. I think whatever can happen will happen. And so that we got that right out of the way before scams like FTX got bigger. In a way, it's a positive thing. This, however, of course, does have a lot of short-term pain that we've been going through, and hopefully that's mostly behind us, but we're still in a bit of a restructuring process. Based on on-chain data, we still see long-term believers accumulating at these prices, and people looking past the fear, uncertainty, and doubt that there is in the market. Finally, we're seeing new products, updates, protocol upgrades, and narratives emerging in the space. So putting all those pieces together, I think it should be an exciting year for crypto, and hope you guys all stick around with us. So that's it for today. Next time on February, we'll be talking about the current market in DeFi and some strategies for those interested. It'll be a bit more hands-on webinar, less theoretical. We have our own, for those that don't know, institutional, I guess, arm where we work with some of the largest companies in crypto executing trading, DeFi trading strategies. So we'll share some alpha on those. So make sure to sign up. I shared the link in the chat for those of you that want to register. And I'll be sticking around for questions for 10 minutes or so. So I see a few already. Give me 1 second. I think Fami was asking, how do I generate this chart on ITB? I imagine you were referring to this one. What I did for this, and you guys can download the data for all our indicators if you have a free trial or an account. So we have the ETH staking amount. So I got the total ETH staked, and I got the supply of staked ETH. And based on that, I derived the Lido share and all that. Yeah, that's a bit more of a quick question. How do you see, Hem is asking, how do you see gaming in 2023 and beyond? So I think gaming is likely to be one of the new verticals that brings new users into crypto. In a way, it collides, it intersects with NFTs. So I think just having an open economy for games will bring a lot of innovation. So open systems historically breed innovation. And with gaming, also historically, we've seen that the innovation has been top down, where game developers build their own like in-game items that they want to buy and things like that. I think in the future, it's likely to become a lot more bottom up, where the users can perhaps build their own game items that they want to use, and resell those, so that will spark a lot of creativity and bring a lot of talent into the space. I think if a game can build a more sustainable approach where it's not just about getting money, if they manage to balance the fun and the economic aspects within it, I think we're likely to see a crypto related game reach 100 million users perhaps by 2024, 2025. Not this year, most likely, but we might be seeing the first few steps for that to develop. And that's why it's definitely one of my top things to look out for in 2023 and beyond. I see a few people thanking me. Thank you guys. Hope you all enjoyed. I have Isa comment here. Proof of reserves has been proposed as one way of gaining consumer confidence in exchanges. Other views are that this is not sufficient nor helpful. What other options do crypto companies have left to adequately share their liquidity positions? Yeah, it's a good question and comment. I think it's better than nothing, frankly, because we can already see on chain like a lot of the activity, and into Block we track the inflows and outflows from exchanges. So I think classifying all of the addresses that they own is already better than nothing, than having no transparency. You're right that it might not be enough. Like you can see now the total amount of Bitcoin on Binance and other assets and other exchanges. That's better than nothing. But of course, if they have something like a debt against the user deposits, like FTX did, you wouldn't see that in the proof of reserves. So that's why many people are also pushing to proof of liabilities. I think that's that's the easy step that most people are pointing to. I think more interestingly, we might see the unbundling of exchanges. So right now, exchanges are the custodian, they're the clearinghouse, they're where trades happen, they do all the stack. I think we might find a bit of a hybrid model where an exchange sits on top of your MetaMask account and you keep custody of your own assets, and then you can just interact with these markets in a way where you're more in control of your assets, but you still access higher liquidity than what's perhaps available in Uniswap or in DeFi. That's a potential route. Also, like you can have the custody with a certified custodian like BitGo, and then they route it to Binance or to another exchange. I'm not exactly sure how that happens, but historically, a lot of innovation goes through bundling and unbundling processes. And after a point of inflection like the FTX collapse and all that revealed all the dark operations that can happen behind a centralized exchange, I think we're likely to unbundle the stack over the near future and restructure in a way. Alberto is asking any trends for ETH staking and validator nodes. So yeah, I think ETH staking, liquid staking derivatives have taken the world by storm, making it easier to stake and also not having to get locked and also put that 32 ETH minimum. I think that trend is probably going to continue growing. As I mentioned, since there's very low outflows per day that will occur after Shanghai. We're playing at Bitblock. I can't reveal too much information, but with ways to boost staking yields. And I think we're probably not the only ones looking into this. But in a way, staking is becoming the native yield across crypto, kind of like T-bills in the traditional economy. So overall, this is going to be like a sub-segment within crypto that is likely to continue growing over the next few decades, especially as all the smart contract platforms have coalesced around proof of staking as the main consensus mechanism. Fami is asking, what do you think about competition landscape in L1s, specifically if L2 solutions work as expected and make Ethereum much more scalable without security flaws? It's a great question. I think like the multi-chain thesis definitely got a bit ahead of time. Like there was a lot of shilling of L1s in 2021 that has dialed back in 2022 and probably continued to in 2023. That being said, I don't think we'll end up with just Ethereum and L2s being the only chains. They do have a moat in the sense that they are the most widely adopted and have the largest developer ecosystem by far. But even L2s after proto-bank sharding, from what my research suggests, it still handles less transactions per second than a network like Solana. There's also issues with composability between L2s. So say if you have a lot of liquidity on Arbitrum, but you have a lending protocol on Optimism, liquidations can't bridge quickly from one L2 to another. So that breaks composability and effectively decreases the potential for those a bit. I think Cosmos has, in a way, pioneered with their IBC, interblockchain communication, easier composability cross-chain. Ethereum is still lagging a bit behind that. So I'm also, interested in what they build there. And Avalanche and Polkadot and a few others are also toying with different alternatives that can potentially lead to massive applications to be built. I think we're likely to see more app chains, which is why Cosmos, Avalanche subnets, and Polkadot have been increasingly relevant, as perhaps more applications opt for MEV as an indirect monetization and not just fees, which can be a bit more intrusive. So all in all, I think perhaps we got ahead of time, ahead of ourselves as an industry with a multi-chain thesis. It might be dialed back in 2023, but I think long-term, it will still be a multi-chain world. Okay, I think I've rambled enough for today. Thank you guys, everyone, for joining. We'll be sharing this in our social media and YouTube if you guys want to share it afterwards. Thank you all very much for your time. Hope you all have a lovely day. Bye, everyone.